Welcome to the Lend Academy podcast, episode number 65. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I am delighted to welcome Brian Weinstein. He is the CIO, the Chief Investment Officer at Blue Elephant Capital, as well as a co-founder. Now, Blue Elephant's been around for a little while. They have been investing in this space. They are an investment management firm totally focused on the lending space. And Brian has a fascinating background coming out of BlackRock for many years, and wanted to get him on the show to talk about what he's hearing from investors and also his perspective on the news and how he feels this is going to impact his business and the industry going forward. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Brian.
Thanks, Peter. Thanks for having me.
Okay, let's just start by giving the listeners a little bit of background about yourself, where your career has gone up to this point.
Sure. Well, currently I am a co-founder of Blue Elephant Capital Management and the CIO. We are a direct lending fund or family of funds. Part of that is marketplace and part of that is different. We can talk about that later. As far as my career, I was, as I say, born and raised at BlackRock. I spent 17 years there when it was a small firm, about 150 people, to 13,000 when I left in the middle of 2014. And before I left, I ran institutional fixed income. So I got to oversee about $300 billion of assets and really be the lead asset allocator over a pretty significant fixed income portfolio. And that's really where I cut my teeth anyway. I was there from an intern, started an inflation business, got to run a global business, got to move to London, and then run the bigger business before I decided to go and do something out on my own.
That's really interesting because, BlackRock, I think they're now considered the world's largest asset manager. And when you joined, I'm sure they were, 140 people. I imagine they had just a tiny fraction of the assets that they have today.
Yeah, no one knew who they were. I used to have to explain to people that we weren't Blackstone and why didn't go to an investment bank. So obviously times have changed.
Right, indeed they have. Everyone knows their name now. Okay, so then let's just talk a little bit about Blue Elephant. What kind of things, your investment philosophy and how you invest your clients' money.
Yeah, the partners here, if you look at the way we founded the firm, are from the buy side. Obviously, BlackRock and two other partners are from the sell side. And we've really gotten to watch two really distinct things happen. Obviously, everyone knows the story about banks, right? Banks being regulated, banks being, kind of disintermediated and kind of taken apart from the inside and made uncompetitive in some ways. So I won't tell that story. I think people generally know it. On my side, on the asset manager side, I got to see a lot of what I call the commoditization of fixed income. In other words, when I started fixed income, it was hard to trade. Most people didn't really know what it was. There were certainly no ETFs. You could trade it in mutual fund form, but it was considered illiquid. And as liquidity came into the space, yields and central banks came in and sovereign wealth funds, and they've driven yields to effectively zero or negative everywhere. Mm-hmm. So fixed income is now liquid, but has very little value. So when we looked around at the world and said, well, people need fixed income. You need a product that gives you real income, and you combine that with the bank opportunity, with the bank stepping away in certain places. We really approach the direct lending space here with the view that there are lots of ways to create income so long as you don't mind having some illiquidity that goes along with that. And so the way we approach the space is the same way I would approach my BlackRock fixed income portfolio, right? When you run a couple $100 billion of fixed income, you can't trade it around. What you buy, you have to assume at some point you will own, and you'll be stuck owning it because the markets tend to seize. So basically, I have a long-term view on the economy. I have a view of where we're going. That directs kind of our diligence. We look for loans of certain quality at certain times. We will go anywhere in quality. Right now, we're focused more higher in quality, and we'll basically build a portfolio that we see as being able to survive the next business cycle, because you're going to hold these loans for, on average around 2 years. And then we'll direct our reinvest towards whatever as the view changes, we'll change our asset allocation as time goes on and with the cash flow that the bonds themselves create.
Okay, so then do you have multiple funds then? Can you explain is there a different approach with different funds? How does it work?
Yeah, we have two funds. The original fund, the Blue Elephant Consumer Fund, is really focused. It's really entirely for onshore investors. It's considered for tax purposes a lender, not to get technically boring, but that's the truth. It has leverage, and our second fund is called the Blue Elephant Peer-to-Peer Income Fund. That fund is for offshore and IRA type investors, and at the moment it has no leverage, and it is not considered a lender. So that's why it's appropriate for those guys. It has a similar asset mix to our consumer fund, but it does not have any leverage applied to it. So slightly different risk profiles, but similar, but the same underlying philosophy.
Right. Okay. And so what? How much leverage do you have on the other fund?
So our fund, it's an interesting question. So we can run anywhere from 0 to 3 times levered.
Yep.
We've run as high last year. We got into the actually high 2s. We came pretty close to maxing that out. We've brought our leverage down. Our leverage ratio for last month was under 1.25.
Wow.
So we are running at the lower end of our historical leverage on purpose, as I think people are starting to see. The risks in the space have started to I think be skewed against us. That's changing again, but we brought down our leverage over the last kind of year and a half on purpose.
So you made the decision, it sounds like a while ago, to start bringing that leverage down. Was that due to macroeconomic conditions that you saw, or what?
Yeah, I think there's two pieces to it. One is certainly macro. We believe that we're later in the cycle than most people do, although it's become a bit more of a common view over the last kind of 6 months. We had that view a while back, and you can see it in the part of the deterioration in credit. In more broadly, I think is just macroeconomic. The second, and this is more topical, is as you can see with some of the more recent noise in the market, I think there had been too much focus on growth at any cost, and our view was that was going to impact the ability of some platforms to make quality loans, and again now that's shifted too. So we brought down the leverage for both reasons. Risk reward, I think it just generally turned against marketplace loans for kind of a period of basically the last year.
Right. Okay. Well, let's segue into that. I know that people are still very interested in what you've got to say about you are deploying capital. I mean, Lending Club is one of the platforms that you have deployed capital to, correct?
Actually, interestingly, we have looked a lot at Lending Club, and we have Prosper loans in our portfolio, but we do not have any exposure to Lending Club, though we know them well, and it was not because of any prediction. Like, we actually think that their loan quality is very similar. We just happen to have gotten better access historically from Prosper, but certainly would never have predicted Lending Club to have any problems like they've had.
Right. Okay. So that makes sense. So then you are. I'd obviously like to get your take on the Lending Club news and what you feel like it means for Lending Club and as well as the industry more broadly.
Yeah, it's a great question. And listen, I'll caveat it by saying I'm going to assume that we might not know all the details, but that there was no deeper fraud or touching of the data, or no more kind of benefiting one investor purposely over another. Obviously, those things are game changers. So if we just kind of keep in mind that what we know, I think what's interesting is that it's a culmination. And again, I wouldn't have predicted this culminating in this way. I think it's the culmination of focus on growth as opposed to loan quality. So, my take on it is that up until the moment that this happened, things were changing, right? People had already noticed that, the more volume that some of these marketplace lenders did, the worse the quality was getting, right? That it was hurting the investor. I think most people who know the industry know that there are some issues with, disclosure or too many, relationships that exist that should not. I mean, we've tried very hard and have our policies are we have no personal investments that conflict in any way with our, with our investors, because we're fiduciaries at BlackRock. If I learned nothing else, it's that when you touch someone else's money, if they have any question about your motivation, they're not, they're going to take that back. So you have to be a fiduciary above all else. And I think what the Lending Club news highlights is that, if you're going to be a lender, raising capital and the ability to raise capital is fantastic. But if you can't deploy that capital into quality loans, you won't survive. And so I think, as I said, if you look at the last couple of months, what have Lending Club and Prosper been doing, and others? They've been tightening their models. they've been increasing the lending rate. And especially in Prosper's case, they've been doing less volume. Capital had become much harder to come by. And of course, the Lending Club news kind of really drove all those points home and caused more capital to flee, which is not a good thing. And I don't think it'll, I don't think it'll last forever. But what it means is we've refocused these lenders on lending. And I think it calls into question the broader business model. Should they have skin in the game? Should they own some of the loans? We can go into that later. But in my mind, the tide is completely turned from one in which I was afraid to invest in marketplace loans, since the middle of last year, to one where I'm actually excited. Because in my mind, if Lending Club and Prosper are going to survive, they have only one way to do that, and that is to show people that they can continue to make loans that perform, service those loans properly, which is something that I also think has gotten lost in some of the noise, and really treat their loan investors, which is really the capital driving the firm, as their clients, as opposed to maximizing volume. So to me, this had to happen. I wouldn't have wanted it to happen this way. But now the focus is back on making loans again, and that is what these companies actually do. So
when you say it had to happen, can you what do you mean exactly? Do you mean what had to happen was more of a movement away from growth, the total focus on growth? What do you mean exactly?
Yeah, I mean, listen, these companies, if they play their cards right, have huge room to grow, right? I mean, I can give you all the stats around what percentage of consumer credit they represent, and it's basically nothing. So my point is that they shouldn't grow, or that my point isn't that they shouldn't grow, that they won't grow. But if your goal is simply to double in size every year because that's just going to maximize your shareholder value, you're just missing some bigger picture things, which is you're going to make the same mistakes banks make, which is you'll make your most loans at the lowest possible rate at the worst point in the credit cycle. That's just, how a careless lender would behave because, again, they're focusing on volume as opposed to future volume. So, if all of a sudden you do, let's say that Lending Club and Prosper did $5 billion of loans each in this month, which would obviously be 5 times the biggest month that we've ever seen. It would look great for the moment, but if half those loans defaulted, then they would never get to make another loan at some point, right? So the focus needs to be what's my sustainable loan growth, and that number changes, right, as the credit cycle changes, and there was just too much focus on let's double, and you can see it in the second half of 2015 will be the worst vintage that I think Lending Club or Prosper will underwrite because the rates were too low and the credit models were just a little bit too lax. And again, that was going to jeopardize their ability at some point in the future to survive. But now that we've completely switched that, I do think they have a chance again to prove that they can make tighter, have a tighter credit process and have a better loan kind of outcome for their capital, which again is the buyers of the loans. But again, all the pieces were in place for that to happen. Lending Club and Prosper had raised rates, each 2 or 3 times since December. Mm-hmm. So it was already starting. They had started to understand the problem. And again, this is a very stark reminder that capital is not always easy to come by. And so I think it will cause them to revisit a lot of the way they approach their loan buyers.
Right. That makes sense. So then I imagine over the last 10 days, we're recording this on May 18th, so it was actually been 9 days, I guess, since the big news from Lending Club. And I imagine you've heard from some of your investors that may get nervous or whatever. So I guess the question is, what have you been hearing, and what are you telling your investors?
Yeah, it's a great question. I mean, we're in some ways, lucky that we've been out telling a story about being cautious around the space. So the first communication I put out to our investors, once we had all the facts, was just what I told you, which is we've been waiting for a moment where the winds kind of turned from against us, where I thought, volume was the focus, to where the wind was at our backs, where I thought underwriting was the focus. And I think this is one of those moments. So my communication to our investors was, listen, there's investors who, run away when there's an issue because, fear is certainly an easy emotion to follow. But if you've been telling the right story and you've minimized your exposure, lowered your leverage, kind of have the right call, this is the moment you've been waiting for, kind of like a call to arms. So we have a lot of investors that have been waiting in the woodwork, kind of, knowing that we have not been as, we've done fine, but we've lowered our returns purposefully by bringing down leverage. But the point is, on a forward basis, I think there's a lot of reason to be bullish as a loan buyer today versus again, I'm not sure if May 8th is the right date, but I think really things have started to turn starting in February with the most recent increases in pricing. So my communication was, listen, there's a lot of news out there. We have no exposure to Lending Club, which again makes us look smart, but I'm not worried about the Lending Club loans, in particular. But our broad view that we've minimized our exposure when rates were too low, tells you we kind of had the right view on the space, and now things are changing. So, investors on our side handled it well. I think away from us, where people have been kind of rah, cheerleading for the space and telling you they can grow forever, you have more questions to answer.
Right. So
I think it will slow down capital raising. Any of these big institutions that were looking at the space, I think will have more questions. And obviously, the Lending Club name itself, they're going to have to figure out a way to regain the trust in that name and get through all these investigations, which will slow things down as well.
Right. So would you consider investing in Lending Club at some point in the future? Let's just assume that the Department of Justice, the SEC investigations that are happening, they don't uncover anything else other than what we already know. What are your thoughts on Lending Club as an originator?
Yeah, listen, I totally would. Again, assuming all those things you said were true, right? Again, my job is as a fiduciary. So if there's any question out there about what they've done with the data, I think you have to hold off. But once it's clear that it's a clean situation, again, in my view, I'm supposed to be almost blind to the underwriter, right? The way we model these loans is if you gave me 1,000 loans and didn't tell me who underwrote them, but gave me the full credit file, I can pull out the ones we want to buy and the price we want to pay for them, right? So remember, as an institution, as opposed to some of the fractional buyers, we don't really have any exposure to the platforms. We have the loans in custody. We have our own backup servicer.
Right.
So in the horrifying scenario where one of these platforms goes down, we've always been ready for that, because it could happen. You never know what's going to happen, right? So the whole point is to have a real structure. So yeah, I would buy Lending Club loans once as a fiduciary, could tell my clients I know that the loan data is correct, which I assume it is. I would just love a little bit more statement from them saying, 100% it is. But I would again, I think Lending Club will have a problem clearing their name, for a little bit of time. But as far as we're concerned, I think their loans, would be something we would totally look at when they were free and clear.
Okay. So then let's just talk about Prosper for a little bit. I mean, do you think that, because, Prosper had a down quarter in the first quarter, the first one they've had since the new management team took over in early 2013. How do you feel about what Prosper is doing as far as, transparency, and as far as some of the issues that were uncovered at Lending Club? How do you feel? How's your confidence in Prosper?
When we've gone back, of course, and asked all the diligence questions we asked again, and about their audits and everything, and again, as far as anyone can tell, they're doing all the right things, and no one's touching their data, and everyone's getting a clean look. Listen, I think based on the disclosure that we got from Lending Club around conflicts of interest, I think all these platforms are going to have to come clean with the little pieces, that might be conflicting. I'd love to know, listen, I think it was yesterday they said that, one of this firm that Lending Club bought a piece in, they had a special deal that over a certain amount of defaults, they would guarantee, they would give them cash back. In my mind, if you want people to trust you, you can't have side agreements like that, right? Either we're all taking the risk, or your shareholders are taking the risk, but we can't have some guys, doing some of each. So, I do think that this is going to be, again, a good thing over time as the industry cleans itself up and starts acting like a finance company / fiduciary, as opposed to, a Silicon Valley firm. I think there are some differences, but it's an interesting question, right? So 3 weeks ago, it seemed like Prosper was, going to be way, way behind Lending Club, and certainly they were from a volume perspective. And then this comes in, should Prosper be able to capitalize on this? You'd think so. But as a loan buyer, I don't really spend that much time thinking about it. I want to know who's making the best loans, who's giving me the best data and the best access. And again, every day we have an API that runs, and we can run through Prosper's, the loans offered in the active pool and pick out the ones we want. That's a great thing for us, and I'm very happy to continue to do that and actually kind of turn it back on again as rates go up and standards get tighter. So, I don't know how they're going to behave as as a firm. It seems to me that since it's clear there's some business model flaws, that the first person to come out with an announcement on how they fixed it will probably have a pretty good advantage. But I don't spend too much time, trying to predict who that will be. I just want to make sure my investors get the best loans at the right price and maximize their return.
Right. Yep. Fair enough. So let's just move beyond Lending Club and Prosper for a second. So who else can you share where you have, where you're deploying capital as far as platforms go?
Yeah, totally. So our biggest exposure, though it's down by a huge percentage, our biggest exposure is Prosper. Our second is actually Harmony, which is a New Zealand-based consumer lender. Some very unique things about the environment in New Zealand that attracted us there, and they performed very, very nicely for us. They are our second biggest. They're, for anyone not familiar, they're very similar in kind of concept to Prosper and Lending Club, but in a much smaller market with a lot less competition. So that's an interesting proposition for us. After that, we have a kind of non-marketplace lender called Freedom Financial that is also doing consumer in a very different way than the marketplace guys. A small amount of exposure to Funding Circle on the small business side. And then the most interesting one, the one that's growing the most quickly, is a lender that we've launched with our own model. They're privately owned, but we were the first one to fund them. And it's called Boat Finance. So we found there was a huge shortage of truly quality collateralized lending being done, and the used marine industry was hurt pretty badly by '08 and the death of the community bank sector. So we actually have a team that's out making secured loans on used recreational boats with very conservative estimates on the valuation of the collateral that has performed very well for us so far. That's the fastest growing part of our book, and something that no one else has access to besides us at the moment.
Right. No, actually, I met the boat finance guys. I think it was like 18 months ago, and fascinating business. I mean, so just on that, as you say, they were hurt by '08, '09. Considering that we're, you've said that we're late in the economic cycle, and let's face it, if we hit another recession, I imagine the boat industry will be hit as well. How do you sort of feel about that, and why are you excited about it?
Yeah. Well, listen, if that's the view, then certainly there's no reason to think that the boat loans would do worse than unsecured consumer loans where you have no recourse to anything.
True.
Right. So there's a couple interesting facts about the marine market. Again, one is that we're not financing new boats. These are used. So the depreciation generally happens. The second is that we are being very conservative, as I said, on the recovery and the valuation of the collateral. And the guys running the company are kind of experts. They've had 30 years of experience in the industry. So we're not assuming that you're going to get back 100%, right? You basically assume you're going to get a haircut. So basically, you set the rate appropriately, and I would expect that those secured boat loans would wildly outperform consumer loans in a recession. It's the guys really doing new boats or being overly optimistic on collateral and recovery where you'll find out that you set your rate too low relative. But since we wrote the model, we don't really see any danger of that. And in a recession, if you look at what happened in '08, basically as the economic cycles get better and better, people start financing these new boats, the larger and larger tickets, and you could lose half the value of it, trying to resell it, the next day if it's like a car. Once you drive it off the lot,
right.
It has no value. But a boat, a fiberglass boat that's already been out in the water for 10 years and is seaworthy, has pretty much a terminal value because you throw new engines on it, and actually it's just as good as a new boat. It's not like a wood boat that rots. So there's some pretty interesting facts about that market. And remember, these are titled, they're insured, so it's not like it's not like you're securing it with copy machines that someone can pick up and walk out of their office. I mean,
right.
The guys that we have doing this are experts in seizing collateral and auctioning collateral. So it's operationally intensive, but I think it's a pretty interesting value proposition. And our goal really is, as we get closer to the turn of the business cycle towards another recession, we want to continue to increase our exposure to secured lending as opposed to unsecured lending.
Right. Okay, so I want to talk about due diligence now. You worked at BlackRock where you were putting hundreds of billions of dollars to work, and I imagine you had a massive team that would be conducting due diligence whenever you're putting new money to work. And obviously at Blue Elephant, you don't have quite that same size. So what do you do when you're looking for a new platform? Say it's Harmony, say it's even Funding Circle or whoever. What are the steps you take, and how is it different to what you did at BlackRock?
Yeah. listen, you're right. At BlackRock, you have an army of people that you say, hey, go figure this out, and someone will figure it out for you. Here, I mean, a couple of things. One, it's an emerging space in a lot of ways. There are a lot of new players that are not as tight kind of operationally as maybe you'd want them to be. So the answer is we kind of have to divide up our time. The first thing we'll do is kind of the broad check. So I have a list. We've looked at now just under like 98 or 99, just under 100 potential lenders, and
Wow.
you heard the list of who we lend through. But we don't do deep due diligence on 100. At BlackRock, you might, right? We don't. So a lot of guys will fail the test in the first case, which is, we always ask, what problem are you solving, right? Is there a market, like, this is all changing now, but before the stock valuations fell, everyone thought they could lend everywhere and they would get, some kind of VC funding no matter what. So the ideas just weren't all that good. And that's obviously, eased off as valuations have fallen. So firstly, you can't just show up and lend, right? Is it underserved by a bank, right? Is there a reason why no one's doing it? Is it a big enough demographic or cohort to attack? So a lot of guys will fail there. And then from there, you get into really two different pieces. One is the credit model. You'll find a lot of guys don't have one, right? So you call yourself a fintech firm, but you use straight FICO as your lending metric. You're probably not going to partner with you unless we can use our model instead, guidelines, et cetera. And then the second part is legal and operational, right? So a lot of guys try to skirt the rules on usury or kind of do regulatory tricks. We don't want to do that. And then operationally, I mean, you should hear our COO go through people. Everyone assumes making loans the hard part. That's the easy part, right? It's can you service the loan? Can you recover? And so what we'll find is, the list of people we have serious due diligence needs on is manageable. So at any time we'll be doing deep due diligence on, say, 3 to 4 kind of lenders of various types. But to your point, yeah, we can't do it on everybody because, we're not BlackRock. So I'm sure we do miss things. Like, listen, the boat guys actually came to us 3 different times, and honestly, I told them no the first 2, and they finally gave me some interesting facts around the lending that they were doing and convinced me. But it does take probably some work to get through to us because we do have a little bit of a backlog on the diligence side. But we can't skimp on it, right? We have to. We want full diligence on anyone that we approve.
Mm-hmm. And so, is your due diligence process going to change given what we've heard in the last couple of weeks, or do you already feel like it's rock solid?
We're always trying to make it better. So I just added to our checklist, this question around, do you have, and we knew these agreements happened. I didn't think they happened at the bigger platforms, but, do you have any agreements that give preferential treatment to one investor over another in terms of buying back defaulted loans, things of that nature. So we're always trying to make it better. And listen, it's really, to diligence, fraud is impossible, right? Like, if people are completely cooking the books and Deloitte and Touche can't see it, or whoever the auditor is, like, that's a unique story. But for a platform that's been through SEC and CFPB, and Cap One, we have a warehouse line with Cap One that we can get leverage with. Like, they did due diligence on Prosper. So in some ways, you get help from partners in that way. A brand new platform that's done nothing, we can actually kind of help control all the processes. So, when you start out with both finance, you don't have the same fears because, you're basically helping them do all the work.
Right.
It's kind of the medium-sized platforms that are the hardest, right? So you have a small loan tape, you have a sum process, but then you have to go back and vet all the information, and it's hard. So, yes, I think if we were looking at a medium-sized platform that had done some volume that was VC funded, we'd really have to do a deeper dive now, probably with legal and maybe even an auditor, to make sure there weren't any irregularities in the loan tape, in a much deeper way than we were doing before. So yes, this will definitely slow down capital movement in the space, even from someone like us who I think was doing a pretty good job in terms of diligence.
Right, but your fund personally, you're not pulling back from the space. It sounds like you're still you're reinvesting.
Yeah, we had pulled back from the space. And again, in my mind, like putting aside the lending club, it would be very unlikely, right? Because someone's been paying these loans back. So, the idea that the loans were somehow fraudulent is, again, I think is far-fetched. But, to the extent lending club doesn't drop any more bombs on us or anyone else, yeah, I think the time to get into the loan space as an institutional investor is just much better now because, again, we can, the more capital we raise, I think the more we can dictate the terms. And, I think all these guys are going to want more locked up capital and everyone wants that, right? But there'll be a price extracted for that for the loan buyer. And before they had so much capital that, as I said, they were just making as many loans as they could. So yeah, we're actually getting ready to run back toward the space as opposed to run away from it from the loan side. I think from the equity side, it's a bit of a difficult question to answer, but again, a lot of the bad news you'd have to believe is in the price.
Yeah, for sure. So does that mean you're going to increase your leverage ratio going forward?
Yeah, I mean, listen, part of that is economic cycle sensitive. So I would say the first thing we're going to do is stabilize it. We've really let the leverage ratio fall. I mean, it's fallen every month since, I would say, April or May of last year. Mm-hmm. So the first thing we're going to do is increase our reinvest and stabilize it. And I don't think we'll bring it back to 2.6 times. That's more of an economic cycle thing. But yeah, I think given the opportunity and the right terms, we could certainly start to bring it up somewhat. It doesn't, I don't think, make a lot of sense to bring it down from here. So things are changing again for the better for loan investors.
Right. So then final question. Let's just talk about where, look into your crystal ball. I know it's a very fluid situation, and we don't, as I said, we're recording this when we don't know what may come out next week. We obviously have no idea. But where do you see the industry, the marketplace lending industry going? I mean, do you see massive contraction? Do you see mild contraction? I don't expect you to see massive growth anytime soon. Yeah. But where do you see the industry going for the next 12 months?
Yeah, listen, I think this is now going to be the time to get to adjust the business models to make them somewhat more rational. So my view has always been that instead of having a number of behemoths that go public and do massive volume, I think there'll still be a few over now a longer period of time. But I think this breaks down in two ways. One is I think there's a certain, I think the stigma that technology valuations have put on having a balance sheet are going to go away. So I think having some loans on balance sheet is actually a good thing. In a lot of ways, it gives you cash flow. It means you believe your underwriting. It has skin in the game. It answers a lot of regulatory questions. So I think you'll see some business model changes. But my view has always been that the second part is there'll be a lot of niche lenders, right? So our goal isn't to go out there and raise a $3 billion fund and buy all Prosper loans. I think that's a tough business model. Our goal is to go out there and raise a $300 to $500 million fund and buy some loans from Prosper and Lending Club and those guys, but also a lot of niche-y players that do some very, very good, unique underwriting. And that means that when the economy turns, you can go out there and say, okay, I want to add 10% subprime or 20% subprime to my portfolio. I want to add some small business to my portfolio. But I think the way the market, this opens up the door in some ways for a lot of niche players to kind of evolve their business model without feeling like they're missing something, which was always, I think, my view on how this was going to turn out. So, I think over the next 12 months, you're going to see some major changes in the marketplace model, which I think will be generally to the benefit of the loan buyer. And then I do think you'll see an evolution in the broad space where a lot of these smaller lenders start to get noticed for their value as I said, smaller kind of balance sheet lenders, which I think is an important evolution. But the idea that you can always maximize volume, I think, will fade away and be replaced by something a bit more rational. So, again, as you say, it's hard to predict massive growth in the space, but I think in some ways it actually saves the space because it means that as loan performance picks back up and we keep the focus on the underwriting, that there's actually a decent chance for rational growth and solid business model changes, and that's a good thing, even for the equity investors over longer periods of time.
Right. Okay. Well, on that note, I'll have to let you go, but I really appreciate hearing your thoughts. It's great to kind of to catch up and find out from someone who's managing a lot of money in the space and what their thoughts are. So thanks for coming on, Brian.
Absolutely. Thank you for having me, and we'll talk again. Hopefully, there's no more bad news.
Yeah. Let's fingers crossed. Okay. See ya.
Thanks.
Bye. I want to pick up on Brian's last point there and just expand on a little bit because something I've been thinking about as well, that maybe this incident, while terrible for Lending Club and for Renaud Laplanche, it may end up being in the long run a good thing for the industry. And the reason being is that there has been this fascination, this obsession almost with growth, where we got to keep growing at these double-digit or even triple-digit percentages every year. And I think that whole idea has just gone out the window now. It is simply not going to be the focus. The focus now is on really building a business that can sustain itself for the long haul, and really focusing on underwriting and doing what is necessary, doing what is important to build a long-term sustainable business. So I hope that is what actually comes out of all this. I think it very well could be, and I think the industry will be much stronger in the long run for it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.